Hi folks, and welcome back to Meaningful Money. Okay, here I am just outside the village of St. Buryan, not far from where I live. We're going to continue our series about advanced investing. Now, we dealt with venture capital trusts last time, and today it's the turn of enterprise investment schemes, which are similar but different in some important ways. As ever though, before I get into that, I've got to thank my good friends at 7 Investment Management who are down here. They sponsor the show, as you know, and help me to keep going, which is great, so I'm very grateful to them. Venture capital trusts that we dealt with last time, remember, had some tax breaks, and they were a means of investing in smaller companies primarily, and in doing so helping the government sort of rally smaller companies, which are the sort of bread and butter of the British economy, and in return for that the government would give tax breaks. Now, enterprise investment schemes are similar and have many of the same tax breaks, plus two important differences. Enterprise investment schemes is more where it's at these days, I have to say. Venture capital trusts have had their tax breaks reduced from what they were. Enterprise investment schemes, the topic of today's video, have actually had their tax breaks increased. Okay. So the companies that can be involved in an enterprise investment scheme, basically if you have a small company which wants to raise some money, they can offer their shares underneath or within this enterprise investment scheme. Whereas venture capital trusts were companies themselves, you remember, and those companies invested in other companies. What happens under an EIS? An EIS is a scheme rather than a company or a product as such. So a company that wants to raise money can issue new shares within this scheme. Now, it's small companies and smaller companies than we were talking about last time. So companies that can issue shares underneath an EIS have to have assets of less than £7 million. That's before they issue the new shares. It has to be less than £8 million afterwards. They have to have fewer than 50 full-time equivalent employees. And importantly, they must be unquoted. Now, that means they're not listed on the major stock markets. Now, bizarrely, it is okay for a company to be listed on something called the AIM stock market. That's the alternative investment market, a market specifically for these small companies. So, generally speaking, they should be unquoted, but that means unquoted on the major stock markets. So, let's turn quickly to these tax reliefs, because that's really what it's all about. Now, just like VCTs, you get income tax relief of 30%. Now, it used to be 20% until April just gone. We're in middle of May 2011 now. So it used to be 20%, but now it's 30%. So if you put 100,000 in, then you will get a £30,000 reduction in your tax bill, which is pretty good, which means you get 100 grand worth of shares under this EIS, but it's only cost you 70 effectively. Now, as with VCTs, you must have a tax bill from other sources, at least equivalent to the tax relief you're hoping to get on the EIS. So, you know, if you have only paid £10,000 in tax from other, say, earned income or whatever, you can't then get £30,000 worth of tax relief from your EIS investment. You must hold your shares under the EIS for 3 years to benefit from that tax relief. You get it in the year that you make the investment, but if you sell the shares within 3 years, you have to give that tax relief back effectively. Okay, and just like last time, the 10% tax credit that you get on dividends, let's say you've got a really big share portfolio and you get dividends from those, the 10% tax credit you get on those does not count towards your sort of general tax bill to cover your tax credit from your EIS investment. Whether that's clear or not, I've no idea. But that's pretty much exactly the same as VCTs. There is a CGT exemption, that's a capital gains tax exemption, which means when you sell your EIS shares, you don't pay capital gains tax on them. That's a pretty valuable perk, okay? That's just the same as VCTs last time. Now, here are two differences from venture capital trusts. Something firstly called loss relief. When you buy or sell something, you make a gain or make a loss. That is charged to capital gains tax, which we dealt with ages and ages ago, okay? With capital gains capital gains, you can offset previous losses. So if I make a £20,000 gain this year, but made a £10,000 loss last year, I can offset one against the other, right? The great thing about enterprise investment schemes is that if you make any losses, you can offset those losses against your income in the year that you make them, or the previous year as it happens, but that's probably slightly muddying the waters a little bit. So if I've got, an income tax bill of 100,000 quid, but I make a £50,000 loss on my enterprise investment scheme, I can actually reduce my income tax bill by £50,000. So that's unique to EISs. And another thing which is also useful, the sort of fourth tax perk, if you like, is capital gains tax deferral. So that means that if I make a gain with a previous investment and I have capital gains tax to pay, if I instead use the proceeds from my previous gain and buy EIS shares, I defer the capital gains tax on my previous gain. So I sort of, roll it on. So let's say I don't want to pay it now for various reasons. I can pay it in the future at some point. So it's again just a means of tax planning. So 4 pretty useful tax reliefs there. Okay. Now these are usually, as I said, direct shares in companies, and if you are a previous owner of that company, remember these are small companies, so very often they're owned by like the management or the family that founded the company or something. If you're connected with that company, some of the reliefs that we've just talked about can be limited, but rather than get into a whole load of figures, that is basically how EIS schemes work, and they're pretty useful. But again, they're generally the preserve of the wealthy, because underlying, remember, it's small companies, high risk of failure. They're a tax perk, and usually they're for people with tax problems. People with tax problems, i.e. big tax bills, usually are pretty wealthy and so can afford to take the risks associated with small company investing. Right? That's enterprise investment schemes, or a very cursory introduction to them. Right? Next time we're going to talk about something called contracts for difference, and that really is the sharp end of investing. This is advanced investing we're talking about at the moment, after all. So thanks very much thanks very much for watching from my little field just outside St. Buryan. I'll see you next time.